Vincent joins us from StoneX Group. He's a global macro strategist. Vincent, firstly, before we get into your report about the kind of hybrid value growth plays, give me just your 60-second take on the market, because we haven't made a NASDAQ high in 3 weeks, and people are starting to freak out.
Yeah, no, to me it seems like it's a market without a narrative, or just tired old narratives that we don't like very much. The main two narratives I would say has been the reopening story, and it's played out. I mean, you were talking about the cruise line. Most of these stocks are higher than where they were before the pandemic. So clearly, at least in the US, this feels old. And then the ARK type, moonshot, meme stonk, clearly has, I mean, you look at where ARK is trading today, is not working very much, and people are not comfortable getting there at these valuations. So we have a market without a narrative, which I think is why people are getting into the Garp idea, because this concept of growth at a reasonable price is what strategists say when they don't know what to say.
All right. And I'm with you on the lack of narrative. That was actually the subject of my newsletter this week, that we need a new story or else the bear one is going to take hold. Vincent, so let's dive into your research here. One of the things that you looked at is the number of companies that overlap between the Russell Growth and Value indexes. This is a super interesting topic, as there are a lot of companies that overlap. Are those good stocks to be in?
Yeah, so I actually took it on face value, the Garp idea. So typically, people come up with Garp as a way to dodge a question. Oh, I think you should buy quality stocks at a cheap price. That way you sound smart. You can get your Barron's Outlook column, but you're not really saying anything. So I thought, okay, let's keep an eye on this. So Russell actually does not have. There's an overlap between the growth and the value indices. So if you look at a Russell 3000 index, there's about 1,000 companies that are both growth and value. Chief among them is Google, which, again, if you consider yourself to be a value investor, finding Google in a value index is just wow. But I think it also speaks to the fact that, when you're index provider, you want to get the big stocks in as many indices as possible, because these stocks are so large that if you don't have Google in your index, people are not going to follow you. So now you actually have a pretty large universe of Garp stocks, stocks that have both growth and value characteristics. So I ran a back test and say, okay, how did that work? And the answer, it didn't work all that well. I mean, it worked well between 2011 and 2017. This was when we had this kind of preference for quality company, for defensive growth, but obviously hasn't worked in the past 5 years. And over the past 25 years, you had no alpha from going into these Garpy names. If you look at this chart, the one you're showing right now, looking at the red bar, looking at the intersection, you'll see that this Garpy portfolio will get you into healthcare, which I like, but also areas like consumer staple. And it's funny, I think Nicole was mentioning Kellogg's, like, we don't know what to do. Let's buy some consumer staple. To me, it's like, if we're really looking at, rising inflation, getting into these quality companies that, are not as overvalued as tech, is not going to do it either. I mean, I could see maybe the market weakens. Yes, you'll have, just a lower beta play, but I really don't see it emerge as like a secular story that could carry the market going forward.
So let's take that image full screen, guys, again, so we can have the viewers see those colors pretty clearly here, because what Vincent's done is highlighted in red the number of companies as a percent in each of these sectors that represent that intersection of Russell growth and value. So the big red bars that show up in healthcare and comm services and in staples in particular that really stand out, those are more of the intersection stocks, those kind of hybrid stocks, than what you see in just a traditional breakdown for these sectors as growth or value. For example, that big green bar shows the amount of companies in the tech sector that are growth, right? So what you're saying here, though, is, Vincent, you have to be in the companies that are also in the major ETFs. And then when you price those and look at the performance, we've got a chart that looks at what you call the fund darlings. So You've gone through the S&P 500 and the NASDAQ 100, found the companies that are these intersection of growth and value, and it looks like over time these index fund darlings, as we see in the red line here, have actually outperformed not just value in the index, but growth overall. Do you think that's sustainable?
I don't know, but I think it's a much more interesting approach than the Garp approach, because here we're touching about, the structural transformation of capital markets with the rise of index fund and the rise of ETFs, and popularity with ETF, I think, is a factor in its own right. I mean, it always amused me when I see like quant strategists coming up with all these esoteric factors, really coming from excessive backtest, when there's this huge one to me, which is, yes, money is flowing from active into passive. If you are in as many indices as possible, you will do better because you get more money. So hence the idea of looking at some that are in the S&P 500, in the NASDAQ 100, classified as growth and value. And then I would suggest adding another one, which is a high ESG rating. And then you get companies that are really at the intersection of this passive momentum story. And indeed, they have outperformed the market, as you see on the chart, for a long time. Going forward, I am generally split. I agree that this is a structural thing. Like, people are not going to go back to active management. Index funds are going to attract more money. ESG ETFs are going to keep attracting more money. So the flow argument is definitely there to support it. Now, the question is, at some point, high valuation depresses future returns. So I actually ran another study on looking at the relation between how popular a stock, how much of a stock is owned by ETFs versus the realized return. And I found that for most of the past decade, there was almost no relation, or even a positive relation. But for the past 3 years, we're starting to see a negative relation between how much of stock is owned by ETFs and its actual return. So at some point, we'll get to an inflection point where, if you get to a passive share of 100%, clearly things don't work. So that at some point, as the passive share rises, returns will be depressed. I don't know what that point is. It could be now, it could be in 2 years. Now,
the companies that stand out in your ETF darling analysis, Alphabet, Pepsi, Texas Instruments, Costco, Starbucks, AMD, ADP, Automatic Data Processing, another one. So you've got some examples here that do meet these criteria, but your point is that we don't really know where that inflection point is, where what was a benefit and a boon to a stock may become a negative. Maybe I would offer one potential answer up, Vincent. Is it when we actually enter a downtrend in the market? I mean, we're getting that in some of the higher growth stuff. What if that actually happens in the index? I mean, even when we've had down moves, it's never been a trend for over a decade, right? COVID was a crash, came back. 2018, we had one breakdown and then turned around, but we never really had like a series of lower lows and lower highs. What would happen if that happened?
Correct, and that is, I mean, you nailed it. We haven't seen this since 2008, really, not a sustained market drawdown. I mean, we had these short but intense crashes, the Volmageddon, the power bear market in 2018, and then even COVID was like, a month, basically, between early February and mid-March. So we haven't seen a market trending lower, which would have time to create this kind of self-reinforcing loop of outflows and the performance. So yes, I think if we see that, I think this is when that ETF darling portfolio is going to suffer. And I would watch for this factor, ETF share of stocks owned by ETF as a factor, and potentially as a risk factor. So I think you would want to be in stocks that are relatively underowned by ETFs as opposed to the ones that are overowned, because you have less of a risk of brutal outflows. And then also at some point the ETF will need to catch up, right? I mean, I was actually quite surprised. I was watching the variation between ETF ownership between various stocks. I mean, some of the most popular, it's about 20% of the float that's owned by ETFs, and then other one is 6 or 7. And I'd much rather be in a 6 or 7% ETF owned stock than a 20%